Equity comp is one of the more common places where returns can get complicated, even when you're being careful. RSUs, ESPPs, stock options, the tax reporting can be complex, and even knowledgeable people can end up with mistakes on returns simply because the paperwork doesn't line up cleanly. Hi, I'm Werba Rubin, partner and wealth advisor at Werba Rubin Papier Wealth. And around tax season, one of the most helpful things you can do is a quick equity comp checklist before you sign the return. One of the most common issues is basis reporting. Your brokerage may show a cost basis that looks right, but it often doesn't reflect the income you already paid tax through your W-2. That's where double counting can occur if it isn't reconciled. Another area is sell to cover transactions. With RSUs, shares are often sold automatically to cover tax withholding, and it can create confusion about what was sold, what was withheld, and what still needs to be reported. ESPPs are another frequent source of mismatch. The discount treatment, qualifying versus disqualifying dispositions, and timing rules are easy to misunderstand, and small errors can ripple through the return. And if you have stock options, especially ISOs, it may be worth paying attention to AMT exposure. AMT isn't something most people think about day to day, but option exercise timing can trigger it in ways that aren't obvious until after the fact. The point is, equity compensation is one of the most common places where tax surprises come from, not because anyone was being aggressive, but because the reporting is complex. So before you sign, it's worth asking, do the forms match what happened? Was income counted once, not twice? And are there any timing issues that need a second look? Equity compensation can be a powerful part of a long-term plan, but the reporting details matter. If you want help coordinating equity comp with the rest of your plan, we're happy to talk.